Talking about this generational wealth transfer and the amount of money going from one generation to the next, and the need and the importance of planning, whether we said earlier estate planning or estate tax planning. One of the big horror stories we know in our industry is the story of the Miami Dolphins. Joe Robbie was the owner of the Miami Dolphins. Upon his death, he hadn't done proper estate planning. His children, who inherited the Dolphins, his piece of the Dolphins, which was about 85% ownership of the Dolphins, had to sell their stake in the Dolphins, ultimately to Wayne Huizenga, for $109 million. At the time, it's still a lot of money, but was a very deep discount to the value of the Dolphins. They did it because as soon as they received the $109 million, they had to pay $47 million of it in taxes, not for the sale, but for the estate taxes due from Joe Robbie. That 47 wasn't necessarily just taxes from the $109 million sales. It was to cover estate taxes because the estate was very illiquid, meaning the bulk of his assets was the Miami Dolphins, which is not a stock you can sell or cash in the bank or a life insurance policy like you've been talking about. Effectively, they were put in the position of a fire sale, right? Can you maybe talk to why that would happen? It would seem that type of an asset, which is pretty solid, and that type of wealth, these shouldn't be problems. But even at that level, whether you're worth however much he was worth or less, how does this happen?
It's a great point to bring up. And I will say that this probably could have been avoided with proper estate planning. Really, the function here is, as you mentioned, illiquidity. So we don't have liquidity at the time that it's needed or liquid cash to pay for debts. And then a function of solving for that estate tax. What happened effectively here was upon the passing, the family had to come up within 9 months the estate tax. Let's say it was 40%. You said the number was 47 million. That is a fabulous amount. And even if you have something like a sports team that's very profitable, the IRS doesn't want as payment for estate taxes part of the business. They only take cash, and they take cash within 9 months of passing. So the kids had to scramble to come together and figure out how to get the IRS paid. So the IRS didn't come in with their own agents and liquidate the assets themselves, basically sell off the company. So it's really a tragedy that, again, tragedy is
It's all relative.
exactly. It's all relative here, but it certainly is a tragedy because you can take a lifetime building wealth and then it can be lost in one transfer, in one generation, one transfer with poor planning. I would say in that situation, what could have been a tremendous opportunity for them would have been to have, of course, some money fall into the lap of the family at the time of the passing. Now, that could have been identifying some other asset or account, or, of course, having life insurance.
The lesson there, and we're talking about obviously the 1% grouping, but this concept of planning to avoid having to come up with the taxes like that in a short period of time isn't necessarily unique.